Welcome to episode 68 of the Real Estate Syndicator Live. And in this episode, we're going to talk about the new SEC rules that just came out last week, I think a week ago on the 23rd, affecting fund managers and all the additional requirements, restrictions, disclosures, all kind of fun stuff. And the reason I wanted to do this video is because I've been getting a lot of questions about it just in general, especially in the community, real estate syndicator community. And I think the best value you're going to get from this video is just the assurances that this probably doesn't affect you. So I want to go do a little bit of a deep dive, but to be fair, most of us in our community that are doing syndications, that are raising capital for real estate or even other funds, most of this stuff isn't going to apply to you, but I wanted to provide the value so at least you have that that peace of mind, so to speak, that it doesn't affect you. So what is this rule all about? This rule affects primarily, or really does affect, fund managers. And remember, the definition of a fund manager is somebody that runs an LLC, a syndication LLC that invests in securities, right? That's the definition of a fund manager. So if you're a syndicator that's out there, even if it's a fund and you're exclusively buying real estate, then for purposes of this rule, this does not apply to you because it only applies to people who are investing, that their syndication is investing in securities. And that's typically people who are investing in other people's syndications. You know, we talk about that all the time, that when you're investing in a fund of funds or somebody else's syndications, you're buying limited partnership interests in another deal. That is a security. Or sometimes we have clients who are raising capital to then issue promissory notes and lend out money. Well, that's also a security. And if you're investing in any other type of financial instrument or a security, but it only covers if you are investing in securities. So if you're a syndicator and you're doing real estate, which I know a lot of us are, then you can probably leave right now. Don't forget to hit the like button. Even if you are in the business of issuing or investing in securities, so probably if you're in my community, you're talking about a situation where you're a fund of funds. This rule, 80% of this rule, maybe 90% of this rule, really only applies to registered investment advisors. And as you guys know, most of us in the community, when we do fund of funds or we invest in securities, we're kind of small time, right? So we typically have an exemption and we don't actually register as an investment advisor, but we're able to find one of the exemptions to registration. That's typically at the state law. We've talked about that, I think, many times on this channel. I think two episodes ago, we actually talked a little bit about fund of funds. And so again, of this rule that applies only to fund managers, 80% of these rules, all these audit rules that you found, or all these other disclosure rules, apply to fund managers who are registered as an investment advisor with the SEC. So that leaves the remaining 20% that really does affect a lot of our clients that are in the business primarily of doing fund of funds. Let's not kid ourselves. That's really the one that is going to apply in our world. And the main rule, which is a big one, the main rule that applies to you as the fund manager is this idea that you can no longer provide preferred treatment, what we call preferential treatment, to your larger investments without letting everybody else know. So it's not uncommon in our fund world that we do what we call side agreements, right? You have a huge investor that comes in our world, it's probably a private equity group, or just somebody comes in with a large investment, and they come in and say, hey, look, I want to negotiate better terms. We want to get, we want this, we want that, whatever. And you typically would do that in a side letter if it doesn't affect the other investors. If it affects the other investors, we typically will disclose it in the PPM, because whatever preferential rights the private equity group or the big group wants, we want to disclose that. But on the other side, if it's a side letter that doesn't really affect the investors, maybe we're giving a piece of the GP to the big private equity group or something, then that's not something that we typically would disclose, because it doesn't affect the investors at all. But what this rule says is that any preferential treatment, any side agreement, any side letter you do with a big either institution or a private equity investor, that's something that you're going to have to disclose to all of the other investors, that all of the LPs now are aware of all the little side deals that you're negotiating and cutting with your bigger investors. So that's probably the biggest piece of this new rule that requires you to disclose. The other thing that some of you might be doing this is you're no longer going to be able to give preferential redemption rights to your preferred investors. Again, it's not uncommon if you're going to accept a big check from a big investor. And again, for us, that's $1 million, $2 million, $3 million private equity investor, to negotiate something where they may get some preferential redemption rights, which means they can get out of the deal ahead of anybody else. And that obviously creates some issues, or there's a conflict of interest for the other investors, because if the deal starts going south, the larger investors are able to get out. They're able to redeem their shares pursuant to the terms of the agreement prior to the other investors. So the SEC has kind of said, well, we're not going to allow that unless, of course, it's required by law, which doesn't really affect us most of the time, or is that redemption right is applied to everyone. So that's another thing that we've got to be careful about, is just making sure that redemption rights aren't given to big investors. And by the way, this is something that I've talked about all the time. We always preach this anyway. So that's why I think from our perspective, it's not going to have a huge effect, just because we're already practicing this way, this conservative way, which is you want to make sure you're treating all your investors equally, right? That's kind of one of our big tenets here at Premier Law Group when we're doing these funds. And so you want to treat everybody the same, at least everybody that's in this particular class. So if you have different classes of investors, yes, you can treat them differently, but typically that's something that's going to be disclosed in the documents in the private placement memorandum. And so we rarely do side letters without disclosure. We rarely do redemption rights from investors, but that's something that we do sometimes do. And then the last one, when it comes to preferential treatment, is just information. It's not uncommon when you're at the larger levels. And again, we're talking about some of these funds that have literally $1 billion in assets under management, where they're actually literally talking to individual investors that come in. And so they're providing each investor different pieces of information from everybody else, which obviously, as you can imagine, can sometimes provide unfair advantage, because somebody may already have the inclination that something's not going well, and they can then kick in with their redemption right. So we want to make sure that, again, everybody, I guess the lesson on the preferential side is just make sure you're treating all of your investors equally. And if you're going to give some preferential treatment to one investor over another, just make sure that that's disclosed. Make sure your attorney is aware that we no longer can do these side agreements where, hey, it only affects the GP, so we're going to give this preferential treatment or additional preferential treatment to these investors because it only affects the GP. So that's the big one on the preferential. And again, for those of you who joined us late, we're talking only about fund managers, meaning managers who manage funds that are investing in securities, which means primarily fund of funds. And also we're talking about situations where fund managers are not registered investment advisors. Because if you're a registered investment advisor, 80% of that rule applies to you. We're only talking about that 20% that applies to all fund managers. So anybody who's doing a fund of funds who's considered a fund manager, that would apply. So the first one would be this preferential treatment. And then the other thing, which is not a huge deal, but I wanted to bring it up, is that you're not there are certain fees that the SEC for all fund managers are restricting. But again, it doesn't really affect the world that we live in, right? So if you're out there and you've got your fund and you're charging asset management fees, that's going to continue to be fine. And then you're obviously charging your carried interest. That's fine. And all of the fees, to be honest with you, that I typically see for a fund manager, none of those really have an issue with the rule itself. Some of the things that, for example, I'll give you an example of what you can't charge is if you've got some regulatory, as the fund manager, if you have some regulatory or compliance fees or expenses, that's not something that you can pass along to the fund. Or if you, as a fund manager, are being investigated or there's an examination from a governmental agency, that's not something that you can then charge back to the fund or do fees. And then the other one is the pro rata. You want to make sure if you're charging fees, you want to make sure you're charging each individual fund that you're investing in your fund of funds model. You want to make sure you're charging them fees proportionately. But again, in our world, in the real estate syndicator community that we live in, most of us are doing real estate. And the only reason why we get caught up in the securities world is because we're buying shares in other people's syndications. And that is technically a security, which kind of opens up all these other rules that we've been talking about. But this specific rule that was passed by the SEC only really applies to those of you who are not registered, or it applies to registered investment advisors. So for most of us, I actually don't think I have a single client that's an actual registered investment advisor that's doing these. This doesn't really apply to you other than those preferential treatments. So hopefully that added value to you, just in the sense that you just realize that when you see these rules out there or somebody brings it up, you can just say, look, I'm not an investment advisor, so most of this doesn't apply to me, or I'm investing in real estate. So if I have a fund and I'm just going out there and acquiring multiple properties in my blind pool fund, whether it's mobile home parks or multifamily or single family, this isn't something that's going to affect you because you're not in the business of investing in securities. Got a couple questions here. So I see one from our good friend, Brandon. Hey, Brandon, nice picture there. So side letters must be disclosed, no preferred redemption rights, and uniform investor updates. Generally, the rule shows they want to see more equal treatment among investors. Yes, that's the big one. They want to make sure that the transparency is, I was going to say the transparency is better, but just to become a little bit more transparent. The fund world is really opaque, right, as you guys know. But again, you got to remember, like it's actually an interesting thing. We were joking about this yesterday. There's a distinction of, for example, when do these rules actually have to be implemented? So maybe I'll get to that real quick, Brandon, before I get back to your comment. But these rules, when these rules need to be implemented, depend on how large your fund is, right? And so check this out: a small fund is a fund that has less than $1.5 billion. Right? You're a small fund if you have less than $1.5 billion of fees, and you're a large fund if you're over $1.5 billion. So you just got to remember that most of these funds that are investing in securities, they're hedge funds, they're private equity funds that are investing in really on security side. But yeah, the whole point and the whole preamble, the whole rule is actually, I just read it, it's 600 freaking pages long. But they wanted to increase transparency, B, take away the conflict of interest, because a lot of times when you have these opaque rules and you're starting to give preferential treatment, especially to the large institutional investors, there's a conflict inherent in there for the fund manager, because they want the big, in our world, $1 million or $5 million investor, because they're obviously going to get the big fees from that. So Brandon, you're spot on. That generally shows that they want more equal treatment among investors. It really is theoretically, it's a win for the limited partners, to be honest with you. But then let's face it, these limited partnerships at these levels, they're not mom and pop investors. They're not investors that are, little old ladies who are putting in their last 50 or 100 grand. These are institutional, sophisticated investors. We're talking pension funds. We're talking sovereign wealth funds. We're talking big institutional qualified investors. So it's not like these are little, unsophisticated limited partners. But because of the opaquity of the law, then a lot of these issues do pop up. So thanks, Brandon, for that comment. And then my mood today one. So basically, any preferential terms of funded funds negotiated with sponsors is now mandatory. Yeah, you've got to disclose that to LPs, which, by the way, there is a practice of doing side letters, but even in today's rules, I mean, if it does have a material effect on the other LPs, you should be disclosing that anyway, right? And if you work with us, you'll see that typically what we do when we have these large, they're really private equity groups that come in, the way we structure these is we disclose it all in the PPM. We say, look, we've got a large institutional investor. It's a private equity group. They're coming in with $2 million, $3 million, and they have requested what we call special private equity rights or special rights. And there's usually a laundry list. It's not just redemptions, but typically when those big private equity groups come into your syndication and they are going to come in and give you a $1 to $2 to $5 million check when everybody else is giving you 50 or 100 grand, they're going to come in with some really strong preferential. They want protection of their investment. They're going to be ahead of the capital stack. They want to be first in, first out. They want to have a seat at the table. There's literally, if you look at our documents, you'll have a section in there that literally lists, it's usually 15 to 20 things that the private equity firm does. So even in today's rule or prior to this rule, that's something that you'd want to disclose. What we wouldn't disclose, just because we don't think it's material, because anything that's material to the investors, meaning it's something that the investors would consider an important fact in making a decision whether to invest or not. Anything that's material to the investors and affects the investors, I believe you should be disclosing that anyway, right? And so where we don't disclose it is when it just doesn't affect the investor. So for example, if you're giving a piece of your GP away, right, in exchange for whatever you're doing, then that shouldn't affect the investors, because they're going to get their whatever their 80-20 or 70-30, and then it's really coming out of your own pocket. If you want to negotiate a reduction in your asset management fees and you want to charge them only 1% when everybody else gets charged 2%, it's coming out of your piece and not everything else. So generally speaking, we were disclosing anyway. But to answer your question, yes, any preferential terms in a fund of funds needs to be disclosed, unless it's required to, unless it's not for purposes for legal purposes. But no, everything should be disclosed. Brandon 1, $1 billion fund is small. Yeah, I know, that's kind of where it was funny, because I was looking at when this needed to be implemented. You've actually still got 12 months, right? So you have 18 months. If you're a small fund, so if you're doing a fund of funds and you're on this call, my guess is you're doing less than 1.5 billion in assets under management. So you've got 18 months to get your act in order. And if you're a larger fund, you got 12 months. So, but yeah, it's kind of funny. Nice office, by the way. Thank you, John. Very aesthetically pleasing. Well, thank you. It's not even complete, but still working on it. All right. Well, that's kind of what I have. If you guys have any specific questions about anything else related to syndication, I'll stick around here a little bit. Or if you have asset protection questions, I don't know if you guys are aware, but just a little sneak peek on the asset protection side. The great state of Texas just amended their statutes and became now one of the preferred asset protection states out there. So we usually talk about Nevada, Wyoming, and Delaware. You can now add the great state of Texas that is become one of those top asset protection states because they have now amended their statutes to extend the charging order protection to single member LLCs. So if you're a resident of Texas, I would start recommending that people set up their holding companies in Texas. Why would you set it up in Nevada or Wyoming if you live in Texas and have that great stuff? So figured I'd add that to you guys. And unless I see something else, I figured this was going to be a quick one. Like I said, I really just wanted to add value in the terms of this is out there. People are posting about this new rule. People are getting not concerned, but they're definitely getting. They want to know what's going on. Does this affect me? Does it not affect me? 80% of this, even if you are doing a fund of funds or buying notes or lending out money, 80% of this thing is not going to affect you. It only affects you in terms of the preferential treatments and the fees. So without further ado, let's get back here next Wednesday. I'll probably do another solo podcast next Wednesday, 4:30. And if you haven't joined the real estate syndicator community, I highly recommend you doing that. You can do it at mauricioroll.com/Facebook group. And until then, we'll see you next week.